Today we'll discuss the fundamentals of investing and how you may get started. We may see so many colors and hundreds, if not thousands of hues as humans that we forget that all colors are made up of three main colors. The investment world may appear to be an infinite field with limitless possibilities. But of all these possibilities are dependent on two sorts of investments: lending investments and ownership investments. Let's take a closer look at both sorts of investing. Simply put, a lending investment is one in which you lend money to a borrower in exchange for a fee, known as interest, until the original loan, also known as principal, is repaid. When opposed to ownership investments, lending investments are often safer and yield a lower return. Certificates of deposits, CDs, treasury bills, and corporate bonds are some of the most popular lending investments. In either of these cases, you're lending money to a bank, the federal government, or a business that pays you an agreed upon interest rate. You must also guarantee that your principal will be returned on a specific date. Let us now consider ownership investments. Bigger profits are possible with ownership investments, but they come with a higher risk. When you buy an asset, whether it's a building or a piece of corporation, you become an owner. This form of investment can provide income or profits for you. Real estate and equities are the most prominent types of ownership investments, and there are two ways for ownership investors to profit. The first is for cash flow income. For example, if you own a duplex, you will receive rental income from your tenants. Or if you own stocks in a company that chooses to give a percentage of profits to its shareholders as dividends, you will receive cash flow from your investment. The second factor is investment appreciation. If you buy real estate in a favorable economic location or shares in a thriving company, your assets should appreciate in value, allowing you to sell them for a better price than when you bought them. While loan investments are more secure, you still risk losing some or all of your money. If you buy a bond for a firm and then the company goes bankrupt, you might not be able to get your money back, because firms are under pressure to pay their obligations before rewarding their shareholders. This choice is safer than buying stocks. Another disadvantage of lending investments is that while you can receive your money back, it may lose value due to inflation. As an example, suppose you purchased a $5,000 lending investment with a 4% yearly return. Let's imagine you put money aside with the intention of buying a car for your freshly born child when he turns 18. Let's say you can buy a car today for $5,000. What you didn't realize is that automobile prices rise at an average of 8% every year. So the $5,000 car you bought today costs an average of $20,000. But when you get your money back, you only get around $10,100. You can only get around half the automobile's value since automotive prices have risen faster than the value of your investment. So it's a good idea to bear in mind that inflation exists, especially if you're investing for a specific purpose like college education, which according to Forbes has climbed at twice the rate of inflation since 1986. It is now up to the investor to decide how much risk and profit they want from these two sorts of investments. You will not benefit from a company's growth if you make a lending investment. If you invested in a Microsoft bond 20 years ago, for example, you will only be reimbursed for the sum agreed upon. If you buy shares, however, you profit from the company's growth and are compensated proportionally. Of course, an item can both appreciate and decrease in value. As a result, owning a duplex comes with a lot more hazards and duties, such as having to fix everything that fails. Now that you know that there are only two sorts of investments, you'll be able to better grasp how certain investments function and determine what you can do to get your desired result. Which investment path to choose will be determined by your financial goals, the speed with which you want to achieve them, and the risks you're ready to face. Let's take a closer look at the various investment vehicles and see how their risks and benefits stack up. First and foremost, there are savings and money market accounts. Keeping your money in a bank savings account is one of the safest methods to quote-unquote invest, because your money earns an interest rate, also known as yield. This is officially called investing. The reason for this is that bank savings accounts are guaranteed by an institution of the federal government known as the FDIC or the Federal Deposit Insurance Corporation, which protects your money up to $250,000 per person, per bank in the event that the bank goes bankrupt. According to CNN Money, all of these safety nets come at a cost. Average savings account yields are 0.6%. According to the Bureau of Labor Statistics, the inflation rate in 2016 was 2.2%, which means that if you left your money in a savings account, you would have lost an average of 2.14% of its value. Instead of lending to a bank, money markets allow you to lend to businesses and other financial organizations for a short period of time or short maturity. The duration of these investments might range from a few weeks to slightly under a year. Money markets are often wholesale transactions involving large sums of money to conduct transactions. Certificates of deposits, government funds, treasury notes, and commercial paper are some of the most common money market assets. It's vital to note that commercial paper is riskier than the others because you're lending money to a company but don't have any collateral or stock options if the company fails to pay you at maturity. This means that you should check a company's track record and credit to avoid investing in organizations that have a history of not paying their bills. The majority of these investments are considered to be among the safest in the market, but they also have the lowest return rates. Bonds, which are also lending assets, are another investing alternative. Because you're lending money to firms, this investment is comparable to money markets, but it takes longer to mature. Short-term bonds mature in a few years, intermediate bonds in 5 to 10 years, and long-term bonds in 30 years or more. Bonds also offer larger returns than money markets, particularly for long-term investments. Bonds typically have a fixed interest rate that is set when the bond is issued. This means that your interest rate will not change over time, giving you a constant and predictable return. However, even with a fixed rate, the value of your bond can fluctuate depending on market conditions. For example, if you have a bond with a fixed interest rate of 5% and the market rate falls to 3%, the bond's value rises because when the market falls to 3%, people will be willing to acquire a 5% bond since it beats the market, but might also fall in value. If you have a 5% bond and the market rises to 7%, the value of your bonds will fall since no one will want to buy a 5% bond when they can acquire a 7% bond for the same price. Bonds are still one of the safest investment options available today. Let's transition from loan to ownership investments. Stocks are the third option. Stocks are ownership shares in a corporation. There are numerous types of enterprises and industries in which you can purchase ownership. There are now two ways for an investor to profit from stocks. One option is for the corporation to distribute profits to its shareholders in the form of a dividend. This is usually a yearly check that you can collect from a percentage of your company's ownership. However, some corporations choose not to do so. The second method an investor might profit from stocks is if the company's value rises along with the stock price. As an investor, you will see an increase in your portfolio from your initial investment if this occurs. If you invested $1,000 in a company's stock at $20 per share and the price rose to $30 per share, your $1,000 investment is now worth $1,500. This is a significant distinction between stocks and bonds. If you bought a $20,000 Microsoft bond 30 years ago at a 6% fixed rate today, you would have $132,000, which isn't terrible. If you had invested $20,000 in Microsoft stock 30 years ago, you would have now nearly $6 million. Actually, you can check this for yourself. Microsoft provides a wonderful tool called Microsoft Investor Relations that allows you to calculate how much you'd be worth if you invested in Microsoft. Individuals can invest in money market funds, which allow fund managers to perform transactions with the money. Some of the most common money market assets include certificates of deposit, government funds, treasury notes, and commercial paper. Commercial paper is riskier than others because you loan money to a company but don't have any collateral or stock options if the company doesn't pay you when a term ends. Stocks, of course, can provide great returns on your investment, but they also carry a higher danger of losing value and possibly reaching zero if the firm is not performing effectively. Another type of ownership investment is real estate, which is perhaps the most basic and has made many wealthy. Not only does this type of investment produce consistent rates over time, but it can also be purchased with borrowed funds, allowing you to leverage a large asset without having to buy it all at once. The value of real estate, like other investments, is determined by the economy's performance, as well as the specifics of your property. For example, if the economy is doing well and creating more jobs at a higher wage, real estate should do well. However, if the community is laying off people and there's an excess of vacant housing due to overbuilding, rent and real estate values are likely to fail. However, if you want to get into the real estate game but don't want to buy and maintain a property, you can buy funds such as mutual funds that invest in real estate properties or related companies. Now, in a future video, we'll talk about mutual funds. If that's something you're interested in, let me know in the comments if that's the video you'd like to see. Another suggestion is to invest internationally. Overseas investments can be deceiving because the type of investments available in other geographical areas are fundamentally different from those available in the United States. Stocks, bonds, and real estate are still available, but they're usually classified individually because they have each their own set of risks and rewards due to the fact that you're playing in a distinct market. Diversification, international securities, and overseas markets do not move in lockstep with the American market. So if the US market goes through a bad patch, you can still benefit from thriving economies elsewhere, and you develop a more balanced portfolio and growth chances overall. If you look at the entire value of stocks and bonds around the world, you'll notice that the United States is only a small part of the picture. If you don't try to invest in other economies, you're missing out on a world of opportunity. This video is based on information from Eric Tyson MBA's book, Mutual Funds for Dummies, and other sources referenced in the video description. This video is for educational purposes only and does not constitute investment advice or a recommendation to purchase or sell any security. Thank you for watching. Don't forget to subscribe, leave a like, and comment down below what you would love to see next. And I'll see you in the next video.